ETF, index and mutual fund. What's the difference and which one you should go with? Well, it turns out which one you choose may end up being a difference between earning or burning heaps of cash. Keep watching and I'll explain why. What up guys, Mate here. So you finally made a decision to be a responsible adult and started putting aside some extra cash to invest. And I say fantastic. And you heard someone saying that picking individual stocks is too risky and that you should hedge your money by putting it into a fund like S&P 500. Well, that sounds about right too, but then you find out that situation is not quite as straightforward as you hope to be, and more you dig into the topic, more obscure terms keep coming up. Well, fret not, I felt the same, and in this video I'll shine some light on what's the difference between mutual fund, index fund and ETF. And at the end of the video I'll add my opinion about which one you're likely better off to invest your hard-earned cash in. But before we start, please do me a favor. If you find this video helpful, go and punch that like button till it turns blue for the YouTube algorithm. That way you not only validate my fragile ego, but also tell YouTube that this content might help other people as well. And just an obligatory disclaimer, I'm not a certified financial advisor, just some dude on YouTube talking finance topics. And so everything presented in this video are just my opinions based on research and personal experience. So please, before investing your money anywhere, always do your own due diligence. And with that out of the way, let's dive right in. Let's start with mutual funds. Mutual funds are the oldest of the three I'm going to talk about in this video. The very first sort of mutual fund ever created goes as far as the Netherlands of the 18th century. Anyway, let's not turn it into a history lesson, but let's talk about the principles. The idea of a mutual fund is simple. Mutual funds pool money from investing public and then, on behalf of its investors, go and buy a whole stack of securities, which is usually a combination of stocks and bonds. Mutual funds are basically a ready-made portfolios of securities designed to achieve specific investment goals. So what are the benefits? Well, there are two main ones. First is convenience and second, diversification. Convenience because it makes life so much easier for investors to buy a single slice of a mutual fund and own a whole basket of various stocks right away, compared to picking and buying each stock individually and paying multiple brokerage fees in the process. It's a godsend. So that way it not only saves time, but also money. Then there's diversification, which is a built-in feature of every mutual fund. What it means is that based on the fund's objective, a fund purchases a variety of securities from different or unrelated sectors. For example, stocks from petroleum, banking and technology industry. So for example, when oil prices tank, there's a chance that technology stocks that are in the fund's portfolio as well will still do pretty well. That will balance things out and offset, well, or at least minimize overall losses, which means that for you as an investor, the risk of losing your invested money is reduced as well. Also, when you pick an actively managed mutual fund, you don't really have to do anything else because all the decision making about where to invest is up to a fund manager. And that brings me to an important thing about mutual funds. Most of the mutual funds are actively managed. What does it mean? Well, it means that there's a fund manager, a person whose role is to make decisions about what securities to buy or sell based on the current market moves in order to increase the overall value of the fund. Basically, when you invest in an actively managed mutual fund, you are trusting your money to some guy, a supposed expert, who you believe knows better about market moves than you. That means that there are at least 4 cons. Number 1 is expense ratio. Majority of mutual funds will charge you arm and leg in annual fees, also known as the expense ratio. This can be anything between 1 to 3% of your holding under management paid every single year. To put it simply, if the expense ratio is 1%, what it means is that from every 1,000 invested, the fund manager will shave off $10 every single year. Doesn't sound like much of a sacrifice? Well, how about if you invest 100,000? In that case, the fund manager will pocket $1,000 every single year. The critically important thing to realize is that this fee is not fixed, but compounds over time just like your investment portfolio. So if you invest $10,000 to an actively managed fund that is able to produce 10% return for 20 years straight, 1% expense ratio means you will get about 11,000 less at the end, which is over 16% of your overall portfolio. And in the case of 2.5% expense ratio, your returns will be diminished by 21,000, which is about 31% of your overall portfolio. And that's crazy. Now let's talk about disadvantage number 2, which is performance. It's a very common practice for mutual funds to lure gullible investors to invest with them using promises of higher than average returns or stories of managers regularly beating the market. And sure, There are times when a fund can really perform extremely well, but what advertising materials often conveniently leave out of the picture are all those years of terrible underperformance. Plus, it was proven by history time and over again that there's not a single mutual fund manager that could consistently beat the market over the average returns. In fact, quite opposite. The study done by Dow Jones Indices looked at 2,800 best performing actively managed mutual funds that were in operation in 2009. Then they selected 25% of those with the best returns that year and asked how many of them actually remained in the top quarter in each of the 4 following years till March 2014. And the answer is 2. As Jess Sommer wrote in New York Times article, quote, "If all of the managers of the 2,862 funds hadn't bothered to try to pick stocks at all, if they had merely flipped coins, they would, as a group, probably have produced better numbers." Another important thing to take into consideration is that the typical mutual funds manager incentives are commissions and fees each investor is charged on the basis of assets under management. That means that even if the fund underperforms and you are losing on your investment, you as an investor will still be charged the annual fee. And that goes into the fund manager's salary and other administrative costs. And so for a fund manager, the primary objective will still rather be to get more investors on board so he can profit from his 1 to 3% expense ratio fees than to increase the overall performance of the fund. And the longer the investor stays, the better for the fund manager, of course. Then there's this thing known as cash drag. No, not this drag, this one. Because mutual funds pull money from thousands of investors, there are chances that some of them decide to pull out and withdraw from the fund every single day. And so for the fund to be able to pay out these investors when it's needed, they have to keep a large amount of their portfolio in cash. And while having a lot of cash is great for liquidity, having a lot of uninvested cash sitting around doesn't earn any return. In fact, it can actually lead to losses because of currency fluctuation and inflation. And finally, mutual funds in general are tax inefficient. Every time a fund manager sells a security for more than he bought it, in other words, when he makes a profit, a capital gain tax is triggered. And guess who's gonna pick up the tab? That's right, you will. Unless you invest in a designated tax-sensitive fund or mutual funds in a tax-deferred account such as 401k or Roth IRA, you better get ready for another unexpected leak in your overall returns. Now, let's talk about index funds. In principle, index fund is a type of mutual fund. Think of them as the younger sibling that was conceived in 1976 by the OG of investing, John Bogle. And while you might not be familiar with the name, you probably heard of Vanguard, the leading investment company that this dude founded. Now, index funds work on a similar principle of pulling money from multiple investors and buying a combination of stocks and bonds. Basically, anything that's good about mutual funds, index funds have it too, such as convenience and diversification. The main and the most important difference is that index funds are passively managed. What it means is there isn't a fund manager making any decisions. But wait, who's deciding about what to include into the fund's portfolio? And the answer is an algorithm, or well, index. And 3 of the most famous market indexes are Dow Jones Industrial, Standard & Poor's, and Nasdaq Composite. If you open Yahoo Finance, these are the very first that will pop up on your screen. But there's actually many more. But what is this index? In simple terms, an index measures performance of a specific group of assets. For example, S&P 500 tracks 500 large cap US companies, where Dow Jones Industrial tracks 30 largest blue chip companies that are traded on New York Stock Exchange and Nasdaq. And so, what an index fund does is that it mimics and replicates these indexes. Confused? Don't be. A lot of people have trouble distinguishing between an index and index fund. So remember, there's only one S&P 500 index and you cannot directly invest into it since it's a purely mathematical construct. But there can be dozens of index funds mimicking the composition of the S&P 500 index, such as Vanguard 500 or Fidelity 500 index fund. So what are the benefits of index funds? Well, the number one and absolutely crucial benefit is that index funds are always extremely low cost. And we are talking about 0.14% expense ratio for Vanguard or even 0.02% for Fidelity 500 index fund. And no, that's not a typo in a decimal point. Now compare that with the average 1 to 3% expense ratio for mutual funds. That's huge. So why is it so cheap? Well, it's simply because there is no fund manager with a fleet of analysts that needs to be paid hefty commission fees. Because all the decision-making process about composition of a fund's portfolio is pretty much automatically decided by the index, there's really no reason to charge investors with high expense ratios. In fact, These low management fees are the main reason why index funds flat out beat pretty much all actively managed funds. But wait, there's more. Index funds are also more tax efficient because they don't participate in day trading. They just buy and hold their investment portfolio until the index itself changes, and that doesn't happen very often. As I mentioned earlier, frequent trades done by mutual fund managers triggers capital gain tax, which is then passed on their shareholders to pay. Same goes to transaction fees. When a mutual fund manager goes and buys a bunch of stocks, the brokerage fees are often passed on investors to pay. None of that happens in case of investing in an index fund. And lastly, there's the benefit of transparency. Contrary to mutual funds where fund managers make gazillions buy and sell orders which are rarely published and in general are hard to keep track of, investing into index funds means you always know what you are actually investing in. Remember, index funds just mimic composition of the publicly visible index. With such knowledge and transparency, you as an investor can better evaluate and understand the risks that index funds you are vested in might be exposed to. Alright, so what are the cons of investing in index funds? Well, truth to be told, there's really more good than bad when it comes to index funds. But if we want to talk about disadvantages, one of them is that it cannot naturally outperform the index it follows. Also, because index funds track indexes with dozens of companies in it, you won't likely see any sudden spikes in gain when one company does extremely well. But the very same thing is the reason why you are shielded against market downturns. For example, the average S&P 500 returns are 10% annually. And sure, you won't become Jeff Bezos overnight with that. But then again, this relative predictability is what makes it a great investment in the long run. Now, let's talk about the third kid on the block. The ETF is the youngest sibling of the three who's been gaining a lot of popularity, especially in recent years. The very first ETF was introduced in 1993 to track the S&P 500 index. But soon, the numbers quickly grew, and now there's roughly 5,000 ETFs as of year 2021. So what is an ETF? ETF stands for Exchange Traded Funds, and in many ways they are similar to index funds. Basically, an ETF, just like a mutual or index fund, is a basket of various securities based on the industry it focuses on. What makes an ETF different is that it trades on the market just like any other stock. You see, if you want to invest in a mutual or index fund, you can't just whip out the Robinhood app and get the thing rolling. You actually have to go through a certain process first. You gotta open an account with Vanguard, Fidelity, or other investment company of your choice. Then there's the approval process. Also, many index funds have a minimum investment requirement. For example, for Vanguard 500 index, you gotta put at least 3,000 on the table to even start. Well, that's not the case with ETF. ETFs look and behave just like any other stocks listed on the market, and you can buy as much or as little as you wish. That also means that the price, just like in case of any other stock, fluctuates throughout the day as people buy and sell, whereas the mutual fund prices changes only once a day after the market closes. Just like mutual and index funds, ETFs are fantastic for diversification since they hold multiple underlying assets. And just like in case of the previous two, ETF focuses on a different industry, collection of stocks, bonds, or markets. For example, SPDR S&P 500 ETF tracks the S&P 500 index, or Stoner's favorite YOLO ETF tracks, and that's not a joke, wheat stocks. So what's the advantage of an ETF? Well, pretty much all the good that was said about index funds applies for ETFs as well, meaning they are typically well diversified baskets of stocks, and they are in general low cost since most of them are passively managed by simply following an index. Even though investors might pay a commission for trading them, just like in case of trading stocks, many ETFs trade for free. But it is important for an investor to have a look at how the ETF is managed, as there are some actively managed ETFs as well. For example, Cathie Wood's actively managed ARK ETF has an expense ratio of 0.75%, which is getting closer to the price of the regular mutual fund than low-cost index funds. Another advantage of an ETF is its flexibility. It's just so much easier and straightforward to buy a share of an ETF compared to investing in a mutual or index fund. Also, ETFs have no minimum initial investment requirement. The only minimum investor has to pay is the actual price of the ETF share. You just go, buy a share, and you're done for the day. Also, because non-US investors cannot directly invest into major US index funds such as from Vanguard or Fidelity, buying an ETF that tracks, for example, S&P 500 is one way to go. So, what are the cons of ETFs? Well, one is more of a psychological nature, because you can trade ETFs like stocks throughout the day where prices fluctuate. You can get tempted to time the market or buy and sell impulsively. And we know that impulsive buying is a way to hell in investment world, right? Another disadvantage is that depending on your broker you are using, each ETF might have different trading fees. Even though these might be negligible, it's important to look out for what are the extras you are paying for. Also, where most index funds automatically reinvest your dividends, which neatly increases your nest egg, most ETFs are obliged to distribute dividends earnings to their investors, meaning they send those dividends to your investment account, which immediately triggers tax liability. If you want to avoid that, you should always look for so-called accumulating ETFs that will automatically reinvest your dividends back, which won't trigger tax liability and will neatly increase your returns in the long run. So there you have it. I hope I managed to explain the key difference between these three bad boys. There is definitely a lot to digest, but if I should summarize all that was said in one sentence, it would be
smash that like button if you haven't done so.
Just kidding. It would be always go for an index fund. Sure, it doesn't guarantee you can never lose your money, but the 40-year history of index funds repeatedly shows that that's where your money is safest. But don't take my word for that. Investing legend Warren Buffett wrote in his 2016 letter to shareholders, quote, "When trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. Both large and small investors should stick with low-cost index funds." Thank you so much if you made it all the way here, and if there's a topic you'd like me to cover next, just leave me a short message in the comments below. Have a good one and see you in the next video. Stay awesome.